3, 2, 1, let's jam. Hello and welcome, everyone. I'm Corey Hoffstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hoffstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
In this episode, I speak with Giuseppe Paleologo, or Gappy, as he likes to be called. Currently on garden leave, Gappy has previously worked in Risk and Quantitative Analytics at Citadel, as head of enterprise risk at Millennium, and most recently as head of risk management at HRT. We begin the conversation with a discussion as to what a quant researcher actually does at a multi-manager hedge fund. As a semi-support role to fundamental PMs, Gappy explains how portfolio manager coverage, factor hedging, and internal alpha capture can all work together to help maximize firm P&L. We then discuss the broad field of factor research and portfolio construction, where Gappy shares some of his strongly held views, both on how factors should be constructed, as well as how they should be utilized. Topics here include returns versus characteristics, mixing versus integrating alpha signals, single versus multi-period optimization, and linear versus non-linear models. Please enjoy my conversation with Giuseppe Paleologo. Gappy, welcome to Flirting with Models. This is a real privilege to catch you while you are on garden leave between firms, and you've worked at some real mega names and bring some really incredible experience to this podcast. So could not be more delighted to have you today. Thank you so much.
Well, thanks to you, Corey. I just wanted to say that I have been listening to your podcast for years and years, so I feel like I already know you.
I appreciate that. So let's get started with just setting the table for folks who maybe haven't been following your meteoric rise to fame on Twitter, at least, with a bit of your background so people can know what your experience is and what you're bringing to the table here.
My name is Giuseppe Paleologo. I go by the nickname Gappy, Gappy. I have been in the industry for about 14 years. Before then, I was an applied mathematician working for IBM Research in Yorktown Heights. I transitioned into finance. First, I moved to Axioma, which is a factor model and optimization provider. I got called by a recruiter for Citadel, so I got hired by Citadel. I worked there twice. I worked at Millennium as head of enterprise risk, at HRT as the first head of risk. In between, I was also a quantitative PM for a relatively small hedge fund. I did leave HRT in November of last year, and I will join Paliasny Asset Management in November. This is public information. And I just want to mention that, of course, everything that I say has nothing to do with my previous and future employers. I wrote a book called Advanced Portfolio Management. I have actually a funny story about this. So advanced portfolio management is actually simple portfolio management. People get caught into this title, Advanced Portfolio Manager. And I am writing a second book called The Elements of Quantitative Investing, which is instead truly advanced portfolio management. So it's meant for the makers of tools and models and portfolio optimization. Whereas advanced portfolio management, I really wrote with fundamental portfolio managers in mind. It's a book dedicated to them, aimed at helping them in their everyday life.
Sort of like a Iceland-Greenland problem. You got the names backwards on the books. Having read both your first book as well as a draft of your second book, I cannot recommend them enough. To your point, advanced portfolio management is not going to be for the most advanced quant. It truly is for the fundamental portfolio manager, but it goes over some wonderful basics. And your new book does not shy away from the math. And I think quant practitioners will really enjoy it from at least the draft I read. And I'm sure it's been far improved from there. I look forward to picking up a copy, and maybe I can get you to send me a signed copy for my desk.
Of course.
You mentioned your breadth of experience. And one of the first questions, actually, someone reached out to me after I mentioned I was having you on the podcast. Someone from Twitter said, well, the first thing I would want to ask, and I think this was a great question, was you have worked at so many different firms that people aspire to work at. What are some of the idiosyncrasies between your Citadels and your Millenniums and your HRTs?
I'll actually quote a co-head of one of these firms, without mentioning his name, who once told me, Citadel is Singapore. It's centrally managed, is very efficiently managed. Everything is clean and working. Millennium is the United States because it's federated. If you want, you could say it's siloed, it's messy, it's big, but things work out in both models. And so I would take that metaphor and I would add that HRT is a little bit like Wakanda. So HRT is smaller, in a sense, is cooler. The human capital, the quality of people, I think is probably the highest among the firms that I've worked at. And they do things in very different ways than the other two.
We'll keep you from getting into too much trouble and mention anything else. I love the metaphor there. Well, let's talk about the roles that you've served in. I think when we use this word quant, there's such a big breadth of what it can mean to be a quant. And whenever I have someone young approach me and say, I'm interested in being a quant, I'm like, you're going to have to tell me more what that means to you, because buy-side equity quant is very different than sell-side derivatives quant is very different than a high-frequency quant. You've served in this role of what's called, quote, a quant researcher at these firms. And can you maybe describe at the highest level what that role actually is? What does it entail? What are the responsibilities?
As a way of introduction, so I have served alternatively in two roles. I was QR in Citadel, twice in the hedge fund. Then I was Risk in Millennium at HRT. I'm going back to QR in BAM. Okay, so I kind of oscillate between the two. The two roles have similarities, but also have fundamental differences. In general, I would say QR is meant to be, in general, quantitative services on the buy side. Otherwise, you would say somebody's strats or a desk quant or something like this, but it's a different role on the sell side. On the buy side, typically a QR person serves central services, does central services for the firm, and those include hedging, internal alpha capture, which we can discuss a little bit later, factor models and custom factors, and then portfolio management advisory or coverage or engagement, call it whatever. But you basically help the portfolio managers in their daily job of understanding their performance and monetizing their ideas. That is, in a nutshell, I think what QR is. There is also sometimes attached to this execution services, a central liquidity book role, also advising the business heads or the head of the hedge fund in allocating risk to individual teams within a business. Typically, the role of the function of allocating risk to the entire business belongs to the CRO or the office of the CRO. In general, the inspiring principle behind QR is that QR is meant to maximize the P&L of the firm by helping the firm monetize better their ideas through repeatable methods. And also, it's meant to help portfolio managers improve. So it's a sort of advisory role to make them better. Risk on the other side, so QR is like the attack function in a football team. And risk is like the defense function in a sport team in general. So you want to make sure that the risk appetite, first of all, of the partners is aligned with the risk that the firm is actually taking, but also understands in detail what the individual strategies do and prevents the firm from incurring into the worst case, or at least makes the worst case tolerable, and develops the methods to measure risk and so on. So risk management is also very, very heavily quantitative. In a sense, risk management is the most intellectual role in the whole firm, in my view. Like risk management is a misnomer. Risk management should be called rational decision-making about investment in a firm. The CRO is truly a very important person. especially on the buy side. So the sell side and the buy side have fundamental differences with respect to these functions. But I would say this, a good, healthy hedge fund has a good and healthy risk management function that matters, that has bite. This is for hedge funds. Now, I do not have as an extensive experience on the prop trading firm side. So my only experience is with HRT. I would say that, again, without getting into details of HRT and how great and unique this place is, but in HRT, I think quantitative research and a quantitative attitude is really underlying the whole firm. So I was in risk there, but everybody is way above average literate in terms of knowing all the basics. So it's different there.
I want to say for listeners, you should definitely buckle up. This might end up being the longest episode I've ever recorded because everything that you just went into, we're going to explore in this episode, all those different roles and functions. This is an exciting one. And I want to start with this idea of portfolio manager coverage, because this isn't one that I find comes up a lot when I'm talking to other quants. Maybe this is more an internally held secret, and it's not a role I hear a lot about when people think about a typical quant researcher. So can you share what the scope of work is when you talk about that portfolio manager coverage concept?
I think that coverage is not a universal term. I believe that it's mostly, originally at least, a Citadel specific nomenclature. But in general, you could call it also a portfolio management advisory or quantitative support, whatever. What does a PM coverage person do? They do help on the two mandates of QR. So the monetize side of things and the advice or analysis side of things. Let's list a little bit the tasks. First of all, there is a very basic thing, which is there is a quantitative framework in most large firms, not only platforms or pod shops, but I would say at this point in any multi-manager hedge fund, which is not necessarily a platform. It could be a 5 p.m. place. It could be even a 1 p.m. place. But in general, most market neutral hedge funds employ risk models, factor models, to performance attribution, risk decomposition, and the like. So this has become a sort of normal thing. And it's coming with baggage. It's not straightforward, especially when a portfolio manager is coming from a different experience. So imagine you have a very talented stock picker who worked for an institutional asset manager or for a family office long only. They come into a pod shop and it's a culture shock because, yes, they rationally can think about their active positions, but it's a very different thing to do it in the context of a long only portfolio versus, well, now my entire portfolio is market neutral and my active positions are 10 times at minimum what they used to be. It really messes up with your head and you don't know what to do. You don't know how much you should trade. So explaining the model and training the PMs is maybe the 0th order of magnitude task. Then from here, what you do is you do some type of advanced risk analysis. So you can explain to a PM where are they taking their risks. You run also a performance attribution. There is something more than the standard performance attribution that you can do. You can do more advanced performance attribution. You develop also these methods jointly, maybe with other parts of the QR team that are not PM facing. And then you solve bespoke problems. What can be these problems? I don't know. In general, for example, you have factor models. Factor models are typically well-defined and well-tuned at the country level. There are also global factor models that cover US and Europe or the entire world. But every time that you go up a level, you're going to lose something in the resolution power. It becomes a trade-off whether to use US versus global. You gain and you lose something. If somebody has only US, for example, coverage, that's okay. But if they have US and Europe, then there are problems, for example, related to market exposures, right? What is market exposure? How you manage that? So there are all sorts of questions. Oh, the loadings in a model are not correct. So you want to address that. And then, of course, there are cases when there are large drawdowns. So go and find out what the source of the drawdown really is. Typically, you cannot explain a lot of the drawdowns in a factor model. So most of the drawdown causes are in what we call idiosyncratic P&L, which is not systematic P&L, it's not market-wide P&L. It's kind of higher order, let's call it higher order systematic causes. And so there is that effort. And then there are lots of problems that you hear from a PM. You have your ear on the ground. And then the coverage person will feed these problems back to the researchers that do factor risk models, or they do internal alpha capture or whatever, so that they solve that. So it's a very important thing. In a sense, everything in QR is downstream of coverage. Like if there is no coverage, there is really no link between pure research and the P&L producers. So it's very, very important to do it well. It's very important to be good listeners, good communicators, have like a sound quantitative training, to have a disciplined research process, because you do, in a way, very short-term research projects all the time, and you don't want to fool yourself or the portfolio managers. There is a very strong fiduciary aspect to this. In a way, you are the portfolio manager's best friend. That is, in a sense, what coverage is.
One of the really interesting data sets that you mentioned that a lot of these firms have is historical trading information, both about the PM that you're covering, but going back over time and cross-sectionally across PMs. You mentioned on our pre-call that you can use this data to help understand the behavior of a PM and urge them to take more risk at times, less risk, help them understand their own behavior better to become sharper traders. So hoping maybe you could expand on what sort of useful studies that data allows in support of PM performance.
You brought to mind one important competitive advantage that especially a platform has over a smaller hedge fund. What a platform brings is a depth and a breadth of data, of actually trading data for a QR person to analyze. In general, when it comes to portfolio managers that are not trading at a very high frequency, slower than a startup for a team. So we are talking about turnover that goes from, let's say, zero. Nobody has a very low turnover in a hedge fund. From zero to, let's say, 15, 20 times a year, even more actually. Having end-of-day data is sufficient for non-startup teams. These are typically end-of-day position data. You can also get nowadays intraday position data. You can get order level information at the PM level in some cases. Most times these are not used because end-of-day data, it's okay to look so-called position P&L, which is what you get if you multiply the close-to-close returns with the end-of-day position data, tends to mimic the actual accounting P&L relatively well. So the difference, you could say, is trading P&L or intraday alpha. Good hedge funds have almost 20 years of historical data on PMs, and they have 50, 100 PMs at any given time. You have this data not at the PM level, you have this data at the analyst level. It really gets a pretty significant data set that allows you to generalize behavior across time, across PMs, across sectors that nobody else has. That's very important. Then what else do you have is kind of table stakes. All decently sized hedge funds and prop trading firms have a large budget for data, for alternative data. So you get good quality returns, you get intraday returns, end of day returns worldwide. You have a good sec master, and you have a wealth of alternative structured data. So you can also probably get in unstructured data, but I would say the role of transforming unstructured data into structured one, it belongs more to a data science team than to a QR person. Your primitives are basically large tables of structured data that you can use to create factor models, custom factors, and various time series analysis and so on.
I read your book, Advanced Portfolio Management, before you and I ever spoke. In hindsight, I now see that book a little bit maybe as a love letter to the fundamental PMs you've worked with, or perhaps somewhat in frustration, hoping you can get them accelerated in their learning. But I'm curious, in all your work with these PMs, what do you think the most unintuitive result arising from the QR research is for them to accept or integrate into their process?
As a PM progresses in the journey toward more and more sophisticated analysis and understanding of their performance, they get surprised at every turn. So I think that a PM who is relatively new to a factor framework will find it surprising. Typically, this is the surprise. Hey, today I made $1 million in NVIDIA, but my idiosyncratic P&L in NVIDIA is negative. I have actually made money, but how come my idio P&L in NVIDIA and maybe for my whole portfolio is negative? Typically, this is asked not in a happy mood. I did make money. I mean, that's my money. Oh, and by the way, they say, I made money in NVIDIA. The market is flat and still my idio P&L is negative. How come? And then you have to explain, you have to show, well, but look, the sub-industry that NVIDIA is in has been making a lot of money today, and NVIDIA is super long momentum at a field day to put these two things together, and that's explaining more than the P&L that you experienced in NVIDIA. So the rest is negative. This is a little bit unintuitive, and if we extend this a little bit, thinking in so-called idiosyncratic space is a little bit hard in the beginning, especially if you're coming from a long-only background. Thinking in idio space is unintuitive, but I think in the long run is very empowering to PMs because they learn to use this to their advantage. And in a sense, they realize that they had confounding variables in their mind that are not there any longer. So they have this separation of concern. I don't care about the market, at least to a first order, but we can discuss not completely, but I don't care about lots of things that were on my mind. And now I can look at, say, divergence in performance in idio space. Another thing that is a little bit more advanced, but true, is every PM believes that they have amazing sizing skills, so that they're really good at sizing their positions. Everybody knows, I think it's common wisdom at this point, that the vast majority of your P&L is coming from being on the right side of the bet of a stock, not from being overly large in a stock, overly small. I can't rationalize why people believe this. I'll try to explain it in very, very qualitative terms. In the cross-section of a portfolio manager, P&L is heavy-tailed. By this, I mean that when you look at the P&L at the end of a year for a PM, typically tends to be equally distributed or fairly equally distributed across names. However, when the P&L is very large positive or very large negative, you will see that the distribution of contribution across stocks becomes very skewed. And basically, a handful of stocks contribute disproportionately to the P&L of that year. So this is really the defining feature of a heavy tail distribution, that when the sum is large, the contribution asymptotically is coming from one or two terms, from the largest term in the sum. This is true, and it's true within a PM, and it's true even across PMs in a platform. When a platform is making a lot of money for some deep statistical reason, there is one business that is contributing 30-40% to the whole P&L. This is a very conspicuous fact. When you see this, other people making this amount of money, or yourself having a killer year, you associate this to sizing. Clearly, it's my top name that made money. So what you want to do is, you want to oversize. But I think this is a little bit of a behavioral bias, a little bit, it's true, but it's conditional on you making a lot of money. In most cases, a portfolio manager is not making that kind of money. And so they think that they have sizing skill. I believe this is sort of an unintuitive result that takes a PM a little bit of time to accept it, but it's also taking a little bit of time to QR people to realize that sometimes oversizing in certain conditions is the right thing to do for PMs.
I want to transition to talking about some of the hedging role. And I want to start with maybe what is a basic fundamental question, but I think an important one, which is how is factor hedging actually performed in a multi-manager shop in your experience? Are you applying the same factor model to every manager in the shop? Are they different factor models? Are you hedging at the PM level, or is it all getting rolled up and hedging at the aggregate level? I was hoping you could share some of the operations there.
Let me define a little bit the terms here because sometimes there is a bit of ambiguity. In the context of a long-short equity book, hedging is a little bit different. Let's say if you are hedging a derivatives book, there are some high-level similarities, but at the same time, not exactly the same. What is similar is that you basically have a core portfolio of positions, be them derivatives or just cash positions. That's a given. The portfolio is given. And you have to add an overlay portfolio that makes the aggregate portfolio desirable under certain lens, under a risk lens. So that's what's similar. What's different is that in the case of an equity portfolio, you do it in an organization, and that's generating a lot of additional complexity. And also, I would say that for 99% of people, hedging is market hedging. Market hedging is straightforward. The betas to the market, well understood, they're quite accurate. You basically compute your hedge ratio, the transaction costs of hedging are relatively low, and you're done. There are details as well. Should you hedge to a future? Should I use SPY? Should I use something else? Perfect. But with a factor model, you have factors. First of all, trading factors is more complicated and more expensive and dirtier than trading the market. The factor portfolios themselves are proxies for the true systematic risk in the market. So that's a pure mathematical issue. Let's talk about the organizational issue. First of all, some firms just don't do hedging. Even very large ones, they don't do hedging. What they do is something that we could call internal hedging, which is you give a PM a mandate, stay within these bounds of your factor risk, and then they will manage their portfolio. They basically are using their whole coverage universe of stocks to keep within that limit. So I am pushing the problem onto the PMs, and good luck with it. The problem with this is that sometimes you have a lot of PMs, even if they are very pure, they are hedging at their own level. They tend to have the same directional exposures to factors. And so the risk compounds linearly, whereas the idiosyncratic risk compounds more or less like the square root of the number of PMs. At some point, if you have enough PMs, your momentum exposure becomes so prevalent that you have to do something. And now you have to hedge anyway. So what do? The first thing you can do is, and I'm talking only about organization here. We're not talking about the math, which is also demanding, but you can create a hedge book at the firm level that contains, let's say, a momentum exposure in the opposite direction to the rest of the firm. What happens is that if momentum is losing money, the firm hedge book makes money. But if momentum is making money, the firm is losing money. So the firm is taking the risk of that hedge book. So what can you do? You can push it one level down by mandating that you are distributing basically the momentum hedge to the individual PMs. That's a possibility. You can choose some intermediate solution where you let PMs transfer some of the momentum hedge that is held at the firm level. You could remove the firm hedge altogether and let the PMs buy a momentum hedge that the firm will create for them, or maybe they can even go to a prime and buy a momentum factor hedge. I don't recommend that. There are ETFs that are momentum factors. They're bad momentum factors. I think that a good QR team should do hedging internally, but just to say there are a variety of configurations. And then what else can you do is you can also have some purely discretionary, not systematic, not programmatic hedging that is decided by the management of the firm. It's the usual problem. Is it hedging or is it alpha? When it becomes discretionary hedging, it's a little bit of both, but that's another possibility. So these are broadly the configurations for hedging.
So far in this conversation, we've spoken about factors in sort of a platonic, abstract way, that they exist, and we assume so far that our definitions of these factors are correct. But when it comes to actual implementation, at the end of the day, idiosyncratic P&L or alpha or whatever you want to call it is ultimately going to be defined by your factor betas. I'd love to know, how do you account for the idea that idiosyncratic risk isn't necessarily pure alpha, and without a ex ante, you've got a fully spanning factor set, you might end up just levering up a factor risk you haven't accounted for yet?
A factor model does really two things at the same time. It does pricing. So imagine the factors don't have any return. So the factors are not anomalies. You don't invest in factors, but you account for factors in the returns of your universe. You do pricing with factors, but you also do anomalies. You want to capture anomalies. You need both. You cannot do anomalies modeling without having pricing. So the factor model serves this twofold role. In addition to that, a factor model, as opposed to most of the economic academic literature, a factor model also predicts risk, which is creating a covariance matrix for your returns. Many, many things at the same time. And what is alpha? Mathematically, it's kind of well defined, but commercially, it's less well defined. What's really alpha is, cynically, alpha is whatever your limited partners are willing to pay for. You could say, well, if I invest in momentum, it's alpha. There is a famous quote by Cochrane, which is a paper called Discount Rates, I think. He talks to a hedge fund manager. I suspect that the hedge fund manager could be Cliff Asness. So if he's listening to this, I'd really appreciate if he says, no, it was me or it wasn't me. But basically, because they're based in Chicago, the hedge fund manager says, yes, these are factors, but I know how to trade them. Cochrane says, there is no alpha. There are factors that you know and factors that you know. There is beta that you know and beta that you don't know. In this respect, you could say there is no alpha. To some extent, everything is a factor, like especially for startup strategies. A lot of what they trade is really pervasive factors. Okay, great, but also not true. There are also things that are really pure alpha, single names, very, very narrow themes. And so what is in the scope of a factor model? And what should be a PM paid for? If they time a momentum, should they be paid for that? Maybe yes. If they are just long momentum, should they be paid for that? Maybe not. There is really no right answer on this. It's all partially negotiable, and it's also all part of a good QR team to design or to devise the right incentives for PMs to create their portfolios. I would say this, though. The number one sign of wisdom, I think, for both portfolio managers and quantitative researchers is a level of humility in understanding that models are, by definition, imperfect. Sometimes there are losses that are not captured by a model, but they are clearly pervasive. So the model is not good. And sometimes there are P&L that is also factor, but it's not captured by the factors. You know it's there, but it's very difficult to pin it down. The model doesn't capture it. It's very hard. People treat factor models as a given. There are many factor models sold by vendors and so on. Factor models are not a solved problem. We are very far from it. That's my contrarian belief.
We're definitely going to dive into factor models quite a bit. Before we go there, though, I want to briefly touch on this idea of internal alpha capture. Factor models are going to be a long discussion. This one, a little less so. So I figure I'll get this one out of the way. I want to talk about this third part of the QR role, which is internal alpha capture. And on our pre-call, you said, quote, once you solve the performance problem, the ongoing problem is how to deploy capital. Can you explain what you meant by that?
I think it's a little bit like in life. First, in life, you solve a performance problem, and then you solve a scaling problem. First, you want to understand that you're good at something, and then you want to maximize your superpower, like you want to succeed the most amount possible at what you do. In a sense, hedge funds face the same problem. They start, and who knows whether they're good or not. They actually refine their processes, they're good, they actually have high Sharpe. Everybody who's sufficiently good, I think at some level of size, can make money. This is a very maybe bold statement to some, but if you're good enough, you can make some money. The difficult part is not to make some money with a high Sharpe, it's to make a lot of money with sufficiently high Sharpe. There are lots of prop trading firms that have a Sharpe of 10. There are strategies in prop trading firms that have a Sharpe of 30. That doesn't even make sense to talk about a Sharpe of 30. But if I make $50 million a year, who cares? The problem is to make $15 billion a year with a Sharpe of 2. It's infinitely harder. And that's where the money is. That's what you want to do. That's what actually, as a hedge fund or whatever you want to achieve, you want to make the most money for your limited partners. So that's actually the most correct metric. How do you do this? By learning how to scale. From a business perspective, learning how to scale means know how to reproduce the model and generate the same incentives for different asset classes. How to build an asset class strategy is really hard, but can be learned and somebody masters it. And then within an asset class, you want to maximize the capacity of that asset class, specifically for fundamental equities. In case you didn't notice, but money really messes up with your head at any level. You make a lot of money, probably you start sniffing coke. You lose a lot of money in a drawdown, and crazy things happen. Like you start developing physical tics. I've seen this happen. They lose their sleep. It happened to me. Like you lose $5 million. It's already terrible. Because of this, portfolio managers sometimes are comfortable running only a certain amount of risk. That's their operating characteristic. Also, sometimes, because they're humans and trade in a human manner, they are not trading optimally, and so their capacity is limited. They cannot really grow that easily. They start seeing the price being affected by their own actions. In cases like this, if a firm is successful, typically they always have more money than what they can easily deploy. You have a success curse. And sometimes, you're taking too much money and it's affecting negatively your returns. And so internal alpha capture is the process of overlaying yet another portfolio to the core portfolios of the portfolio managers, designed in an efficient way so that it allocates the right risk to the individual sources of alphas. It removes the behavioral biases in trading of the original sources of alphas, trades that optimally, and deploy the additional capital and generates additional P&L for the firm. So that's what's called internal alpha capture. Why it's internal? Because, and this is where it gets a little bit subjective, but I think that a mandate of an internal alpha capture team, as the term says, is you are by mandate using only your internal alphas. If you are starting commingling your internal alphas with external signals, then I think that the problem becomes a little bit more opaque. And in general, you should have a separation thing, the separation theorem. If you have external signals, you're welcome to start your own low frequency systematic external alpha capture book.
When you think about the ROI of your activities, how does the ROI of PM coverage compare to the ROI of internal alpha capture when you're looking at firm-wide P&L?
I'm going to be very subjective here. In terms of P&L, not thinking at the margin, but thinking in absolute terms, internal alpha capture has an incredible value. It can, in some cases, almost double the P&L of a fundamental business, maybe tops double. Even if it's increasing it by 30%, it's a lot. It's on average is an incredible contribution. And it's a very challenging problem. In terms of ROI in absolute terms, compared to the alternative, it's huge. Once you get to the operating efficiency of alpha capture, it becomes very hard to improve at the margin. It becomes really hard to find that extra juice. To make another 0.5%, it becomes challenging. There are still lots of problems. The world changes all the time and whatnot. At the margin, once you are at the operating efficiency envelope, that's becoming a difficult problem. Coverage has a lower ROI compared to a PM left unattended. You come in, you improve a little bit, you tell somebody, don't do this, don't do obvious mistakes. But the benefit of coverage is that it's an ongoing learning process. There is not a maximum for coverage. Nobody has solved the investment problem and nobody has solved the coverage problem. There is always a lot of improvement that compounds over time. At this point, compared to the old, I think, PM stock picker who was completely oblivious to factors, coverage as a whole has added also like another 50% in risk-adjusted performance. And it will keep going for the indefinite future. Coverage has a very difficult to quantify ROI in terms of communicating and extending the problem for internal alpha capture and whatnot. Now, hedging doesn't increase P&L in any ways, but it improves the Sharpe ratio of the strategy. By how much? From, I would say, theoretical maybe 50%, which is huge, to a more achievable, 10, 20%. You can consider that also ROI, because if the firm thinks in terms of risk, if I have a 20% higher Sharpe, I can take more risk. I reduce my risk by 20%, I scale up by 20%, and I have 20% more P&L. So it's also very, very valuable. And they all come together, because if I can deploy more risk, then I have an alpha capture problem. I need to deploy this risk in some way. So it's difficult to put exactly a number on it, except that, internal alpha capture can really contribute a lot to the P&L of a firm. But all three are important in different ways.
All right, let's get into the meat and potatoes of factor research here. We got a lot to cover, but let's start with maybe a bit of a basic one here, which is that it's often said that in factor models, academics use return where practitioners use characteristics. I know this is something you feel strongly about. Why are characteristics a superior means of creating factors?
As a background for the listener who is not steeped into factor models or equity, I think there are lots of people who are actually derivatives people among your audience. You are most likely seen the Fama French 93 paper or some more recent paper that's mentioning Fama French. Fama French has a very specific way of constructing a factor model that actually originates in another paper by Fama Macbeth from 1973. Those papers employ time series covariances between the stock returns and a factor proxy. What Corey was referring to is that instead, if you open the manual of Barra or Axioma model, you will see not the covariance of the stock returns to a factor portfolio that captures price to book. It's not the correlation between a price to book factor portfolio and NVIDIA's return. It's actually the book to price value characteristic of that firm. Or I could use earnings to price. That's another measure. Why is characteristics beating covariances built the Fama French model? You could argue, first of all, characteristics are not historical, and they can actually be, by definition, forward-looking. I could include earning consensus in my earnings to price, and in fact, you will do it. Characteristics are not long-term time series covariances that are, by definition, backward-looking. They capture more or less the point-in-time features of the stock. It's also very intuitive. I am trying to snapshot all the relevant features, like in a regression problem. I want to know, this is the firm right now. Characteristics do not explicitly describe the risk of a firm in terms of a risk exposure to a time series factor. They're really meant to explain the returns of the firm right now in the cross-section based on what they look like right now. There is also an academic, if you want, validation, which is mostly initiated, I think, by Kent Daniel. Basically, about 20 years ago, he and co-authors, I think Daniel and Titman, compared covariances versus characteristics. And you can see if I have covariances and then I do characteristics afterwards in the same model, do I have additional explanatory power? Or how about the other way around? Characteristics tend to be superior. Characteristics also tend to be easy to integrate in large factor models. There are structural problems when you have multiple covariances multiple models in a covariance-based factor model, it becomes a little bit more complicated to create these proxy portfolios. In general, characteristics tend to perform quite well in practice and to be very flexible.
I want to tie back to an answer you had before to my question about factor spanning and this definition of idiosyncratic risk. In your answer there, you spoke both about book to price and earnings to price as possible characteristics to define a factor, both of which I would say typically are characterized under the value factor. But you could also consider something like momentum, where you've got 3-month momentum or you've got 12-month momentum. Or you could look at momentum within a specific sector, healthcare momentum. And naively, these choices are going to define different outcomes for the factor. And I'm curious, in your perspective, how important are those specific choices to the ultimate end result of what you're trying to get at with factor hedging or factor models in general?
For factor hedging, they do matter a lot. So let's look first at the genesis of these characteristics. Where are they coming from? And I would say that commercial vendors include those because they get published. They appear in some paper. And the way they are appearing in a paper and they're justified there is because each individual characteristic is tested in isolation against a standard model, which is the FAMA French model, typically only as a pricing anomaly, in the sense that this factor explains some additional excess return in excess of the market. Book to price, it's in the original FAMA French 3-factor model, but then you can say, oh, I have also earning to price, I have earnings variation, I have profitability, and they are all different anomalies. So one will be called value, another one will be called profitability, another one will be called quality, and so on. Now, problems. First of all, the way that they come about, it's a little bit suspicious because it's a little bit like adding one variable at the time to a 3-variable regression problem, but never looking at the presence of all these variables at the same time in a model. And because this is the way academics publish paper and get tenure probably, but this is one problem. So when you put them together, they end up very often explaining each other. There is a level of redundancy. And then sometimes you observe that the characteristics themselves at any given point in time across the stocks tend to be correlated. So that's called the collinearity problem. If you remember your linear regression, when you have two collinear predictors, the outcome of your regression becomes unstable because the error around the parameters of your regression becomes inflated as a function of the collinearity of these characteristics. And when it becomes inflated in finance, the inflation happens on the error estimates of the factors themselves. And this error propagates into the purity or the lack of idiosyncratic risk into these factor portfolios. So I would say that the choice of factors is important. It's important for hedging specifically also because you start having to hedge to factors that are really very noisy in a sense. And there is a perverse incentive by vendors to add factors to models all the time or to come with the current fashion. Like at some point, Barra introduced some alpha factors. I won't opine on the specific choices, but definitely if the vendors came up with a 10-factor model and that's it, that would be probably commercially suicidal. And this is one of the reasons why QR teams spend a lot of time developing custom factor models, because they are tailored to the needs of their firm and because in a sense they are more intellectually rigorous.
One of the words that comes up all the time when talking about factor research is this phrase orthogonalization. And that comes up especially among practitioners. What is it? Why is it so important? Why is it relevant to fundamental PMs who are looking at their portfolio through this factor lens?
This answer requires a little bit of remembering of basic regression. Aside from that, I think that a lot of your listeners who are interested in quant investing or interested in data science, probably in their library, they have The Elements of Statistical Learning by Friedman, Halstein, and Tibshirani. which is a very nice book. It's kind of old, but it's still very nice. And there is a beautiful section there, which I recommend, which is multivariate regression as a sequence of univariate regressions. In a nutshell, you could do a multivariate regression in one shot, or imagine that you have a technology or a solver that does one univariate regression at a time. So what you can do is I regress my y variable against one predictor. Then I take the residual, so the error from this first regression. Then I have a second predictor. And what I do is counterintuitively, I regress the second predictor against the first predictor. And I take the residual of this regression. So I do really two regressions, y variables versus first predictor, and then second predictor against first predictor. And then second step is I do regress the residual from y versus first predictor against the residual of second predictor versus first predictor. Basically, now you have two residuals that you regress one against the other. Regressing the second predictor against the first predictor has the intuition that I take that part of the second predictor that I cannot explain by the first predictor. That's called orthogonalization. It has many beautiful properties. Among them is the fact I do not need to re-estimate the coefficient of the first predictor. I can add the second predictor and the third predictor and so on. And each one of them is basically adding what I can't explain from the first predictor to the regression. So that's why it's called orthogonalization. And what it does is helping you understand what is the contribution to returns from any additional variable that I have introduced. And that's nice and terrible at the same time. It's nice because I don't have to re-estimate a factor model, for example, and it's telling me what I really can understand in addition, adding a new variable. It's terrible because you will find often that if I orthogonalize, a lot of things that seemed to have value don't have actually value in terms of factors. They are not good factors. Is that a bad thing? Yes and no. You cannot add those variables as factors, but maybe they still have some predicted value in terms of being themes, or maybe they are very, very predictive at some points in time, and so on. But this is what orthogonalization is. It's basically trying to understand, estimate the additional prediction value of a variable against the test bed of existing factors. It's an intellectual process, really. Many people who typically are not in the professional realm don't do it because they do not have access to a factor model.
You've been in the field of factor research for quite some time. You're currently polishing your newest book, which covers factor research quite extensively. I saw recently on Twitter you were doing a large literature review of factor research. What strongly held views do you have about factor construction and maybe factor models in general that you don't think would necessarily be shared by your peers?
I will reiterate a couple of things that I mentioned before, but it's worth repeating. So the first is factor models are a solved problem. That's boring. I have heard this from very senior people. I've heard this from people I interviewed for jobs. How difficult could it be to make a factor model? You have your inputs, you do the cross-sectional regression, you do your factor returns, you do exponentially with a moving average. Typically, when I hear this, I think that the person that I'm interviewing doesn't know what they don't know. Actually, it's a very dangerous thing to have just a little knowledge. We really don't know what a good factor model should be. There are challenges that are coming from incentives for vendors, history, because once you have established a factor model, it's very difficult to recant or to change dramatically. It's a very technical problem, so it's a deep problem. It's not like, oh, you do a PCA or something. It's far from being a solved problem. And I would also say it's not a problem that you can ignore. You cannot say, well, let's throw deep learning at it. It's conceptually needed and it's difficult. So there is still a lot of work to do. Another common wisdom is more factors are always better. This is interesting because in a way you could argue more factors could be better. So there are some papers that say you could actually have infinite factors. But if you want to do factors for risk management and portfolio construction, you do have actually a physical limit in the number of factors. You could have infinite predictors. That's great to capture anomalies, but I don't think that realistically you can have infinite predictors of risk. There is a lot of talk about crowding. Crowding is one of really the two major sources of risk for hedge funds. I mean, you have market risk, you hedge to this, but then there is crowding, which is basically the overlapping, having everybody the same ideas and everybody being forced to liquidate your book at the same time, sometimes called liquidity spirals. Crowding is typically added as a factor in factor models, which is okay. I'm not saying that it's the wrong thing to do, but crowding is not a factor. Why it's not a factor? Because really it's an endogenous event. It's not coming from the outside. It's not something that repeats day after day. Crowding is a little bit like momentum, which is also probably a very anomalous factor, in the sense that it's like a dynamical system, is generated by agents clearly interacting with each other, having consensus, and there is a mimetic process where we copy each other and we bet on the same stocks and we self-create our success. And then we also self-create our distraction. And how this process comes to be, it's complicated. It's another open problem, but you cannot just say, I'm adding a crowding factor, which is going to make money most of the time, and then once in a while, I am losing a lot of money. That's not that useful as a factor. It's not that insightful as a factor either. Factor modeling is still a wide open field. More factors are better. Crowding is just a factor that you added to a factor model.
So I remember, certain listeners are going to remember this forum, but there was a forum called Nuclear Finance that was very prevalent back in 2000, maybe 2006 or 2011. It was sort of in its heyday. And I remember reading a theory there where someone posited that the adoption of factor models across firms like Citadel and Millennium and HRT, by adopting all the same factor model, everyone adopting the Barra model, for example, was leading to these crowding effects. And over time, I've heard that same thing mentioned, but with other things added in, such as you now have a consolidation of capital towards these major firms, so that there's fewer smaller firms that are able to operate anymore. They can't compete. And so you get a consolidation of capital into these fewer firms using potentially similar factor models. And then you get some IP crossover as people move from Millennium to Citadel. And so that actually leads to increased convergence of the factor model IP. All of this leading to an increased risk of crowding and quant quake-esque like events going forward. Is it just a boogeyman? What are your thoughts there?
Let's split the question or the statements in your broader question. So I read this as multiple questions. So the first is there some crowding in the space? First of all, to some extent, this can be quantified because you can look at the crowding characteristic maybe over time. Actually, I'm not sure that you would see this necessarily in the crowding characteristic. However, it's like obscenity. You feel it when you see it. There is a sense of being in a crowded space. But the answer to this question is, in my view, yes. Some spaces are becoming more crowded. I'll try to justify this later. There's a second question. The second question is, but everybody is doing, for example, the same thing with factor models. And this is generating crowding. To this, I have a strong view that it's BS. It's the kind of common wisdom that people repeat mindlessly without thinking too carefully about the statement. If you do a relatively simple model of how having exactly the same factor model for every participant could generate crowding in alphas, you will come to nothing. There is absolutely nothing. It can actually generate dispersion across alphas. But in general, I can show at some point that that's not generating crowding. It's not concentrating the vector of alphas across participants. Not strongly held view, not true that everybody managing risk the same way to the same factor models is generating crowding.
Is there a potential argument that even though it doesn't necessarily create crowding in the alphas, it can create crowding in the hedging of those betas?
I don't think so. But I can tell you, and that's actually beautiful, that if you looked a few years ago and you looked at the factor models typically used to be published with the new fundamental characteristics, they used to be published the first day of the month. Then typically they get validated. It takes not 1 or 2 days, and then they get into production at hedge funds. And then you have updated loadings. So you have updated exposures and you are outside of your bound and you need to hedge. Let's say on the third or fourth day of the month, hedging had to happen because the model generated these breaches. And sometimes you could see that certain factors had large movements at the beginning of the month. These were the hedge books. That effect has disappeared because the factor models, the risk models are updated more frequently, and also the way the hedge books are traded nowadays, it's a little bit more sophisticated. You don't hedge once a month. In the good old days, people were hedging once a month, not happening. I don't think it's really, strictly speaking, was crowding, but in a sense, yes, it was caused by the factor models. I would say, yeah, partially yes. We go back to the alphas. Right now, it's not the risk models. However, I think there is more crowding. And the reason, though, I think it's different. And it's like an empirical reason. Just look around. The hedging industry has consolidated. In terms of number of firms, it's kind of the same. AUM, concentration in terms of size, not the same at all. There was this LCH study that showed that 38% of the P&L in the past 3 years in hedge funds was generated by 3 firms. 38%. Citadel, Millennium, and Shaw. Inception of the hedge fund industry to date, the top 20 firms have generated 19% of the total P&L generated in the industry ever. So this tells you how concentrated the industry is, and it's getting more concentrated. And then on the opposite side, like on the supply side, you have 2 more effects. One is the growth of passive, which ranges from the low teens to more like 40%. It's crazy. 40% of AUM is passive. In the good old days, in 87, there is a paper by Jeremy Stein that says 48% of flow was retail. Nowadays, it used to be 10, now it's maybe 15. It's a shadow of its former self. Passive used to be 0, it's almost 40%. So now you have a very small pool of capital where a very small number of players invests. And then what is the last leg of this stool? After 2008, the regular supply of fundamental investors that was coming from the sell side basically dried up because prop trading and asset management was reduced. The balance sheet of banks was reduced. Now you have an unholy turnover inside the industry of PMs that go from one platform to the other to another hedge fund. And so they all know each other and they talk to each other. And this generates a lot of consensus across firms. So this is my purely anecdotal explanation of why you do see crowding, you do see more consensus, you do see crowding as a factor behaving in more violent ways. And sometimes it's great. It's great when everybody has the same ideas in a growing sector. You buy up each other's position. This is more and more resembling a little bit of a game of musical chairs sometimes.
One of the areas we haven't touched upon yet in this conversation is portfolio construction. And in academic research, and even in some practitioner implementations, there's this default to naively sorting on alpha signals. Is this an area where QR can help portfolio managers create more risk-efficient portfolios through something like optimization?
One way to construct a portfolio, and there's nothing too wrong with it, it's perfectly understandable, is I have a characteristic in mind. I sort the stocks according to this characteristic. Let's say, for example, that I do a text analysis of all the utterances of presidential candidates, and I can get an idea from their programs, platforms, and whatnot of what sectors they are favoring and what sectors they are instead wanting to regulate in the future. Before the election, I am, say, a sell-side firm, a bank. I will produce a portfolio with long the top 50 firms that Trump favors and short the bottom 50, and I do the same for Harris. Okay, so I have created my portfolios from sorts. And then you can say, well, as a bank, guess what? I can also help you trade those. So we are all happy. Understandable. Is this a good way of producing a Trump versus Harris portfolio? I would say no. And why it isn't? Because of a number of things. First of all, you're only using a subset of the universe. You can have a measure that is cardinal measure, so it goes from continuously from -1 to 1. Why restrict yourself to, let's say, 40% of the universe? Why dichotomize your data? One of the common wisdom in statistics is do not dichotomize data if you can help it. The second thing that's wrong with this is that you are giving me a very dirty portfolio. This portfolio will have momentum exposures. It will have value exposures, sector exposure. So I'd like to purify this portfolio by using a factor model. The third objection is that the portfolio is sort of insensitive to the risk of the firm. If I am on the long side and I'm investing in, let's say, NVIDIA and IBM, they have massively different risk characteristics. Weighting them the same, it's a crime against humanity. There are many things that portfolios from sorts do wrong, and that's one of the things where a thoughtful QR and portfolio construction process can help.
Another area of portfolio construction that to me is still an unsettled debate is the question of how to combine alpha signals. I mean, there were a lot of papers written about this in like 2015, 2016, with the big question of, is it better to mix alpha signals in a portfolio or integrate the signals together to come up with a single unified signal from which to then optimize your portfolio? So a mixed approach basically builds a portfolio for each alpha signal and then combines those portfolios, and then an integrated approach combines the alpha scores together. I'm curious where you come down in that debate.
I have a Reddit AMA and somebody asked the same question. It's such a beautiful and deep question that I cannot do it justice. So what I would like to do, instead of answering the question, I'm going to restate the question and add a little bit of minimal contribution like I can give. But the reality is, it's better to understand for people how important this question is than to have Gappy's take on it. You can formulate these questions in multiple ways. So one is, I think, what you're asking originally, which is, let's say I have 20 portfolio managers in healthcare. I mean, that's an aberration. They have 20 sets of alphas for the same universe. They're trading their portfolios. And I could say, well, I am the hedge fund manager. I don't care. Give me the portfolios and I'm going to, let's say, multiply them by 2. And there's my internal alpha capture book. I'm just going to replicate them. Give me your positions. I don't care how you think. I'm going to go that way. An alternative view is, no, give me your alphas. And then I'm going to do some magic on the alphas. And then I am going to create a portfolio based on these alphas. What's the right thing to do? I can tell you that under some toy, high idealized conditions, that everybody is a mean variance optimizer, both the hedge fund and the individual portfolio managers, some additional conditions. I have actually a section in my upcoming book on this. You can actually show that the portfolios are going to be exactly the same, which is kind of reassuring because, as a matter of fact, the idea of combining portfolios instead of signals is very common because it's much easier, it's much more commercial, practical, and this is telling you, it's validating you're doing the right thing. If you did all magic on alphas, you wouldn't get better. In practice, though, it's a toy model, and in practice, I think it's safe to say that if you get the alphas, and then at the very least you trade them efficiently, you cannot do worse than just taking the portfolios. It's massively more complex. The real question is, how big is the gap? How much better can I do? And this is really an empirical question. There is no theorem that will help you. You just have to do it and trial and error and so on. That's why internal alpha capture is such a difficult problem. That's one question. Let's abstract it a little bit. I have alphas, okay, from 20 portfolio managers. And now these alphas are real alphas. Somebody's trading 20 times a year and somebody's trading 5 times a year. These are not the same alphas. And they have different information coefficient. One is from a great PM, one different breadth. They have different characteristics. Imagine that I just want to combine alphas that I think have a high predictive power one day out with some alphas that have a great predictive power 1 month out. How do I combine this into a single alpha? Should I do it or not? The problem of alpha combination at the same horizon and across multiple horizons is really, really important, because then it affects your portfolio. In the absence of transaction costs, who cares? When you actually pay a price, then you want to really have the right forward curve for your alphas. There is a firm called Jacobs Levy, and they have this old paper, The Law of One Alpha. They basically integrate all their theses into one alpha per asset. I think it stands to reason that that should be the right thing to do. It's a very difficult problem. It's a very interesting problem. I couldn't find a lot of literature. I know people who combine things in very naive ways, and we don't know whether it's the right way or the wrong way. How much can we monetize if we did it the right way?
All I know is that when I was doing research on this problem back in the mid 2010s, you had very high intellect people on both sides of the debate.
So there is another paper, in fairness, there is a paper by some Goldman Sachs people from 2018, and they show that signals is better. But why do they show that signal is better? Because they do portfolios from sorts. If you do portfolios from sorts, all bets are off, but that's not the way you want to do it in the first place. And they had long-only portfolios.
Yeah, I think I sent you a quick research note I had written where if you do portfolios from sorts, you actually end up with different concentrations if you're selecting the same number of stocks. And so there's a lot of complications to this question, and it's a fascinating question. On this idea of creating this forward curve of alphas, it brings to mind for me this idea of single period optimization versus designing a portfolio with multi-period optimization. And there's a lot of research papers around multi-period optimization. I tend to find when talking to practitioners, we all just sort of end up defaulting to single period optimization. From your perspective, do you think multi-period is just sort of this interesting research curiosity, or do you think it's something that folks can actually use in practice?
I think as the conversation goes on, I kind of lower my diplomatic barriers and I get more and more undiplomatic, more openly opinionated. Let's summarize the problem. Alphas have a term structure, number one. Trading is history depending. I could trade a little bit today and tomorrow and so on. I could trade all in one shot. And in general, my trading today affects my decisions tomorrow. So intuitively, there is a multi-period aspect to optimization. There are many papers on multi-period optimization published. And here is where I get opinionated. I think that because these papers are written by academics who have never worked in the industry, they are really solving for the wrong problem. I don't find these papers usually very useful. There are some better approximations of the approach, but in the vast majority, for example, they will optimize for a terminal state. So it's more of an execution problem by a sell-side firm. But again, it's even too idealized for that. So forget the academic literature, because there is a big disconnect with practice. In practice, there are wildly successful, systematic, not even discretionary, wildly successful systematic teams that do single period optimization. And if multi-period optimization is such a good thing to do, then I'd like to explain how come these really good people are leaving money on the table. There are also some teams that do multi-period optimization. The interesting thing is that there are successful teams that don't do it. The one thing I'd like to kind of advance a little bit in my upcoming book is that there are sufficiently interesting cases where you can show that doing multi-period optimization is well approximated by doing single period optimization. You basically change your parameters in your single period, you tune your parameters, and you're solving essentially a multi-period optimization. Not unlike when you estimate the state in a linear system with, say, Kalman filter, you don't need to solve a super complicated problem. You take essentially a moving average or a weighted average of your previous state and your current observations. In the same spirit, if not the same math, you could be doing the right thing by doing single period optimization, but not always. The term structure of your alphas is really weird, which can be. I have an event, I have earnings in the future, and so I trade for earnings. Yes, sure. If I am trading earnings in the future, or if I'm trading index rebalancing in the future, I have other problems to be concerned with. Execution is one of many problems and probably not the biggest problem. So my view in summary is right now is that multi-period optimization is obviously the right thing to do. It's also possible that in practice, most scenarios boil down to solving a single period optimization. You'll be fine that way.
Part of the conversation here that's gone a little bit unspoken is that we're predominantly talking about equities. When we talk about factors, typically it's talking about equities. Curious as to your thoughts. Do you think these models, techniques, views, everything we've talked about in the quant research role, portfolio manager coverage, all that stuff extends to other asset classes, or is this something that is unique to equities?
I do believe that it has good applications outside of equities. Not only believe, I know that it does. There are successful strategies outside of equities that employ factor models. I would add a couple of things. The first one is elderly wisdom, maybe, but sometimes you know that some things that you do are wrong, but you do them anyway. If I do a factor model on bonds, clearly it's the wrong thing to do. And if I do an unholy panel of bonds, futures, and maybe credit bonds and swaps, the thing should be on paper really not the thing you want to do. But why do you do it anyway? Even if you know that the returns are not stationary, you do that because you need a measure of risk. And across asset classes, the only thing that you can share is returns. And so you do a factor model. And guess what? It's okay. For risk purposes, it can be okay. The more principled way to do this is if you have a specific asset class, for example, bonds, you don't want to do factor models necessarily on the bond returns. You want to map your asset class into a space where the parameters can be modeled essentially as a linear model, as a factor model. So I basically want to model the dynamics of the yield curve. Now, I don't think that any sane person models the volatility surface parameters as a factor model. But in principle, if you wanted, you could do something like that. Map the problem into a proper space, fundamentally do a linear model or a generalized linear model, get your predictions and map it back. That would be a more principled approach. That's not what I've done in the past because I am a slob, I'm lazy or whatever like you. But I do get emails from people saying, what you're doing gives me a lot of ideas. But I don't know if their ideas are of a mathematical nature or maybe are of a sexual nature. I doubt it's the latter. But I don't inquire further. Let's put it this way.
Concepts of factor models go back 50 plus years now. These aren't really new ideas. Where do you think the fertile ground is for research going forward? Where should people be spending their time?
There is the obvious answer, which is that we have this transformative technologies, infrastructure technology, and sometimes mathematical technologies in the form of universal approximators. The technology is not deep learning. The technology is over-parameterized, large-scale models that can run on, in the future, will be 1 million GPUs or something like that. Right now, state-of-the-art is a few tens of thousands. We are porting an old technology. I mean, really, CUDA is not designed for this. Once we can scale this so that it can carry the energy load and the number load, we don't know exactly what this will do, right? But the technology is being put in place. It would be criminal not to try to use it to identify better factor models for risk and for returns. How? The jury's out. You could create a small number of factors, but with 10 billion predictors, 10 billion characteristics. Why not? Well, actually, there is a why not reason, which is, with the exception of high frequency, unfortunately, we live in a data poor environment. That's another challenge. But the technology is there, and there is, I think, a lot of white space to explore. The other area that's so interesting is, and people talk about it since also 50 years ago, and it has not delivered, on its promises is, in general, agent-based or trying to have a microstructural model of how investors play against each other, because understanding, even to a very broad level, very rough level, how these things happen will help us understand crowding. So this is important for investing. I would say it's also important for regulators. There are papers written by academics that unfortunately are not very good, because I think academics don't pay enough attention to reality sometimes. In general, agent-based modeling crowding, it's a vastly underexplored field. And by the way, talking about technologies that are old, neural networks are older than factor models. They have gone through 2 cycles of hype, but the reality is it's not even 2006 to present. I mean, it's really the past 10-ish year for a very old technology. I mean, in principle, in 1946, McCullough and Pitts had all our data and all our technologies. Maybe they would have done something like this already 70 years ago. So old stuff is not bad.
On the idea of old stuff is not bad versus new stuff, your new book is basically glorified linear regression. And in many ways, the world is moving and being revolutionized by nonlinear models. So maybe you can talk to me a little bit about that, your view on machine learning and nonlinear models versus standard old school linear regression, and with the slight enhancements of course, regularization and all that stuff.
In the spirit of I'm getting more and more opinionated and maybe a little snarky, but as a heuristic for the readers out there, if you see a book titled Technology X in Language Y applied to field Z, don't buy that book. A book that starts from a technology and tries to map it to a real problem is almost by definition probabilistically doomed to failure. You don't say, oh, I have machine learning and now I'm applying it to finance. You don't write a book about Python in finance or whatever. You will get old very quickly. So in this spirit, I will make the statement that techniques and theory in general are the easy part. They are cheap. Theory is cheap. Technology in the broad sense is cheap. Reinforcement learning is cheap. Everybody can read a book on reinforcement learning and retool it superficially for finance. That's not how you create progress in a field. Ideally, I wanted to write a book that used only 50-year-old plus math. To some extent, yes, but I'm also not, because I'm using Rademacher complexity, which is a machine learning concept, 20-year-old in machine learning, but it's really 40 years old in function analysis. So I do actually use a little bit of advanced tools, but if I could, it's great that you do stuff that is 100 years old, because it's a sort of Lindy principle. You know that this stuff will be more or less valid for the next 100 years. If something that you do doesn't pan out in terms of anomalies in a generalized linear model, I think it's very, very unlikely that it will work out in a super complex nonlinear model. The super complex nonlinear model is going to give you the 5 to 10 year additional yield. But if you don't know how to do things right using linear regression or dynamic factor models, which are an extension of that to finance, I think that's the problem. So I find that my direct experience is when I talk to candidates, they have an inkling of how to use Keras, which is basically an interface to TensorFlow, or the latest fashionable content, but they don't really know what's the meaning of linear regression. They don't know what's the protocol to testing a model. I wrote this book really for them, not for the person who has a PhD from MIT and does deep learning for a living. I think that it would be useful for them as well, but the philosophy of the book is it's important to think about simple things deeply. That's the philosophy of the book. I believe that there is a lot of depth behind the surface, even for the simplest problem and the simplest model.
You might have just given me the name of the podcast. Thinking about simple things deeply.
I would be delighted.
Maybe it's not catchy enough.
Yeah, it's a little bit too long.
As we come towards the end here, I've got some sweep up questions. We didn't talk a ton about what a head of risk role is and what it looks like, but one of my personal favorite books that I love to go revisit is Red Blooded Risk by Aaron Brown. And he argued that an effective risk manager shouldn't just tap the PM on the shoulder when they've taken too much risk, but they should also be responsible for encouraging a PM to take more risk when necessary, trying to strike that right balance of risk. What do you think an effective head of risk role really looks like?
I did mention before that a good risk manager is a person who thinks rationally about investment, not at the single security level, but at the firm level. So in a sense, a good risk manager helps allocate risk, for example, to different businesses. In this spirit, a risk manager has real influence if she or he is an effective risk manager on the owner of the firm. First, sometimes there are lower bounds on the volatility that individual businesses have to deploy, and the risk manager basically tells or decides you have to run between $50 million of annual vol and $70 million of annual vol. So sometimes when people hit on the bottom, the risk manager will encourage the portfolio manager to deploy more. But I would say even at the deeper level, sometimes there are some trades or some businesses that the partners of the firm don't want to deploy risk in. And sometimes the risk manager has to advocate for these businesses to deploy more risk, to take the risk. It did happen to me. I think it happens to everybody who is, I think, doing their jobs. It's very, very important. It's not only saying no, it's also saying do more of this. Why? Because I have some empirical evidence that this is the right thing to do at this time, or we can afford to do that. This is what I think a good risk manager does too.
Not every portfolio manager is necessarily blessed with a full QR support team. What would be your advice to fundamental PMs or maybe even individual traders who are operating outside of that support structure for integrating some of these concepts into their day-to-day process?
Sometimes occasional readers of my book or my Twitter feed tend to conflate or confuse quantitative research with quantitative coverage, and they're not the same thing. So it's the same difference that's between the blue book, Advanced Portfolio Management, which is for fundamental managers, and the book that I'm writing right now, which is for quantitative researchers. I think that you can do a lot of quantitative research to support very, very simple rules. Your operating system is doing a lot of complicated stuff under the surface. Do you know what's the architecture of your operating system? Is it monolithic, microkernel? You don't. You just know how to use the Windows interface. You can do excellent factor-based risk management and portfolio construction with Excel, with some product and a few other functions. You can use a few well-motivated heuristics. You don't need necessarily a QR person to be 85% effective. I am absolutely convinced of this. And in fact, if I have a little bit of a regret, is my first book is 200-page long. I think I could fit the content and even better in 100-page. Nobody will ever publish it, so maybe it's got to be a free electronic book. It can be done. Fundamental managers should not be discouraged. You can be a fantastic stock picker. You can even have 20 stocks in your portfolio, and you can still make good use of simple rules about diversification, factor exposures, and so on. I know this for a fact.
So as we come to the close of this episode here, I want to ask you the same question that I'm asking all of my guests this season, with the caveat that I don't want the answer to be about your book. And the question is, what are you obsessed with today? And I know that you're obsessed with finishing your book, but maybe outside of the world of finance, are there things you're reading or studying or listening to or shows you're watching or things that you're doing that you are just absolutely obsessed with?
Specifically right now, I am watching a lot of old movies. I do love watching movies. HBO in particular, Max, has a good subset of the Criterion Collection. I recommend everybody to watch watch the entire Kurosawa set of movies on HBO. They're just amazing. The latest movie I watched with my sons was I saw the TV Glow, which is a sad movie, but very good. We talked about this forever. I read a lot of literature. I read the same poets over and over. So if I could recommend one poet to quants, because typically resonates well with them, is Wisława Szymborska. She's a Nobel Prize winner, but she in particular has a way of writing that person with a quantitative background will appreciate. So I do read a lot. I have a couple of motorcycles. That's my luxury.
I do want to say I find that ironic for a head of risk, given the stats and probabilities.
Yeah, many people notice that. But actually, it's the same thing. When I interviewed at the HRT, not that I was a motorcyclist, they didn't know that, but it was a plus that I had been a portfolio manager. It's important to take risks in order to manage risks. You could say this is cognitive behavioral therapy. You need to take risk and be outside of your comfort zone all the time. Motorcycling, but I have many other things. I collect pocket knives and fountain pens. We could have a full episode on pocket knives.
Well, maybe that's what we'll do the next 2 hours about.
It's a very specific hobby.
Gappy, this has been a real treat. I am glad we were able to make this happen while you were on garden leave. I do hope you will at least be allowed to continue to tweet and share some of your insights and thoughts as you exit garden leave, but I really appreciate this opportunity and you taking the time.
This was a lot of fun, and it's one item off my bucket list.
Thank you.